Welcome to vTalkInsight, Market Drivers Daily for April 29th, 2026. Oil, rates, and AI earnings are colliding today to test how much pressure risk assets can absorb before valuations and volatility reset. Brent is grinding higher on Middle East tensions. The Federal Reserve looks more divided just as inflation reaccelerates, and over $14 trillion of AI-heavy market cap is set to report. Let's start with the geopolitical and energy backdrop. Geopolitics and energy are still setting the macro tone, and the Iran confrontation is now expressing itself most clearly through the oil channel rather than outright equity risk-off. The ongoing United States naval blockade in the Strait of Hormuz has sharply reduced shipping traffic, with only a handful of vessels transiting at much higher insurance costs, and dozens of Iranian-linked tankers reportedly turned around or delayed. United States logistics have been reconfigured to support an extended deployment, signaling this blockade can run for weeks or months without operational strain. This pressure is feeding directly into prices. Brent crude has rallied for 8 consecutive sessions, gaining close to 27% and trading near yearly highs around $115 to $120, while gasoline and WTI sit at 52-week highs. Both front-month and longer-dated futures have broken to new highs, and December Brent now trades close to $90 or above, telling you markets expect higher for longer not just in policy rates, but also in energy, with a persistent inflation impulse into year-end. The macro story, however, is more nuanced than a simple recession call. Analysis suggests oil would likely need to average between $150 and $175 for around 6 months before it meaningfully dents global GDP growth. And even in that scenario, a full-blown global recession is not the base case. The United States economy is described as more energy independent and structurally less vulnerable to oil shocks than in past cycles, which helps explain why headline growth and travel demand are softening at the margin rather than collapsing, even as stagflation worries rise. That said, sustained high oil and gasoline prices still act like a tax, eroding real disposable income and squeezing corporate margins, with air travel, logistics, and petroleum-intensive sectors most exposed. Micro signals are already visible. Booking Holdings has trimmed its outlook, pointing to weaker travel flows on Middle East routes and disruptions at hubs like Dubai, while Spirit Airlines faces acute stress from engine issues, failed consolidation, and higher fuel costs. At the same time, Chinese demand for physical gold remains strong, with persistent local price premiums, and several emerging market central banks are seen diversifying reserves toward gold as a hedge against sanctions risk and dollar exposure, reinforcing a structural bid for safe havens. Despite this backdrop, broad equity indices are largely discounting Iran-related risks and remain more focused on earnings and central bank meetings, with some institutional stances still described as overweight risk assets. The key tail risk is that a decisive move in Brent well above the $110 to $130 range, if prolonged, could finally force a repricing of risk assets. In summary, markets are treating the Hormuz shock as manageable for now, but the longer prices stay elevated, the more it complicates inflation and policy. That brings us naturally to the Federal Reserve and the broader monetary backdrop. The rate story is shifting from an easing narrative to a higher for longer and more uncertain regime. The Federal Reserve has kept the policy rate unchanged, characterizing its stance as at the high end of neutral or only mildly restrictive, yet inflation has moved the wrong way, with headline personal consumption expenditures running at 3.5% year over year and core at 3.2%, driven in large part by the recent oil spike. Recent communication has dropped softer language around inflation being only somewhat elevated and instead stresses data dependence and a meeting-by-meeting approach, signaling a high bar for both cuts and fresh hikes. Markets have reacted by aggressively repricing the path of policy rather than waiting for explicit Fed guidance. Front-end Treasury yields have climbed around 10 basis points on the latest shift in tone, with shorter maturities retesting recent highs and 5-year yields hovering near psychologically important levels close to 5%. Long-end yields are also pushing up, with a 30-year approaching prior peaks near 4.95% despite no new hikes. Fed funds futures have now largely removed rate cuts for this year and have pushed easing expectations out toward 2026 and beyond, with some measures showing less than a 50% chance of any cut through mid-2027. Inside the Fed, the debate is becoming unusually public. The latest decision saw an 8-4 split, with 3 members pushing to remove the easing bias and dissent reaching its highest level since the early 1990s, underscoring substantial policy divergence on the committee. There is active discussion about downplaying tools like the dot plot to preserve flexibility, even as officials reiterate their commitment to independence and to returning inflation to the 2% target over time. At the same time, they acknowledge that repeated supply shocks from the pandemic, war, tariffs, and now oil are constraints that interest rate policy cannot fully offset. That combination of internal division, limited control over key drivers, and a more hawkish tone on inflation naturally raises the risk of more volatile market reactions to future meetings. Against this backdrop, talk of stagflation has reemerged. Oil-driven inflation is squeezing consumers, yet growth remains resilient, and passive flows plus AI-related capital expenditure are keeping overall liquidity ample, reducing any perceived urgency to ease. There are warnings that an overly aggressive pace of quantitative tightening could undermine equities by draining liquidity, even if it improves long-run economic health, while others argue the United States remains on a soft landing track and that energy shocks may prove transitory. Bond markets reflect this tension. Some participants see relative value in the front end after curve flattening, but that view depends heavily on whether headline inflation from oil spills in a core, which would likely force a more hawkish stance and keep 5-year yields elevated. In short, policy is on hold but not settled. The critical watch points now are small wording changes in upcoming Fed and European central bank statements, any sustained move of the 10-year yield toward or above 5%, and how long energy prices stay near today's highs. All of that feeds directly into the third major driver today, the AI-led tech complex at the center of the earnings calendar. The AI theme remains both the main growth engine and a focal point for valuation and concentration risks. Over $14 trillion of market capitalization, heavily skewed to AI-intensive megacap technology, is set to report around the same time, and markets see this earnings cluster as a key inflection point for near-term equity sentiment. Attention is squarely on capital expenditure commentary. Excessive caution could challenge the AI growth narrative, while very aggressive spending without clear revenue traction could raise fresh questions about returns and margin pressure. On the positive side, there are multiple signs that AI spending is already translating into real revenue. Amazon Web Services is expected to show a re-acceleration, with revenue growth moving from the mid-20s into the high 20s or low 30s, supported by strong AI demand and commentary around a roughly $15 billion AI revenue run rate. Google Cloud is anticipated to grow even faster, with some investors looking for mid-50 to mid-60% year-over-year gains on the back of large AI deals and a potential doubling of capex, while Meta is projected to significantly outgrow the broader digital ad market, helped by AI-driven ad tools. Outside the hyperscalers, durable goods data show robust orders for computers and electronics, and companies like Bloom Energy are raising guidance on data center power demand, reinforcing the idea that AI infrastructure is driving one of the largest capital investment cycles in history. Yet the risks around this story are becoming more visible. Tech sector valuations remain elevated, and recent sell-offs in big names like Microsoft, Meta, and Amazon highlight how sensitive these stocks are to even small disappointments in growth or capex efficiency. Meta's plan to lift capital expenditure by around $10 billion, much of it for internal AI use, has raised investor concerns about near-term returns and margin compression, especially as detailed monetization strategies beyond advertising, such as application programming interfaces or subscriptions, remain less defined. There are also questions about the true economics of AI. Some analysts argue current service prices are effectively subsidized, with the full cost of data centers and, increasingly, high energy prices yet to be fully reflected, while OpenAI's decision to scale back its long-term capex commitment and delay a potential initial public offering hints at more caution on the investment horizon. That tension between powerful fundamentals and mounting skepticism is driving bubble-like worries. Current dynamics resemble past episodes, with gains concentrated in a narrow group of AI and semiconductor leaders, passive flows amplifying the move, and rapid revenue ramps from zero to tens of billions of dollars at firms like Anthropic and OpenAI, feeding bullish narratives. At the same time, there are structural tailwinds. The build-out of AI infrastructure and energy grids is expected to be a multi-year cycle. Institutional demand for financing data centers, liquefied natural gas, renewables, and grid upgrades is robust, and AI is already lifting productivity metrics in sectors such as financial services. Looking ahead, the critical signals will be how today's earnings cluster addresses AI-specific revenue guidance, power and energy constraints, and the balance between shareholder returns and reinvestment. Together with the path of oil and rates, that will determine whether the AI complex can continue to offset macro headwinds or whether markets begin to demand a broader leadership rotation. To wrap up, Middle East tensions and the Strait of Hormuz blockade are keeping Brent on an 8-day winning streak, embedding a higher energy cost base into inflation and growth debates, even as equities mostly look through the headlines. The Federal Reserve sits on hold, but with a more hawkish tone and rising internal dissent, while markets have largely priced out near-term cuts and pushed easing expectations well into the future. Against that backdrop, an AI-driven earnings super day will help determine whether cloud, semiconductors, and mega-cap platforms can continue to power risk assets despite higher oil and higher yields, or whether questions around capex discipline and sustainability start to dominate. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.